What if I told you your credit score has almost nothing to do with how you're doing financially? That three-digit number is not a measure of financial success. It's just a tool banks use to figure out how much money they can make off of you. Yet millions of people stress about it, lose sleep over it, and even stay trapped in debt to keep it looking good. Today, I'm going to show you why your credit score does not define you and what actually does. Let's go.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Welcome to the Financial Mirror, and thanks for joining me today as we continue to work to improve the one thing that we can control, ourselves. Here at the Financial Mirror, it is not about the numbers and spreadsheets, but about transforming and educating you on money so that you can make smarter financial decisions. If this is the first time you're joining in, don't forget to hit subscribe on YouTube to be notified of all the new episodes as they release. If you're listening to this on Rumble, don't forget to follow the channel and like the video. And on any podcast platform of your choice, don't forget to like and subscribe to the podcast. So I want to start off with a simple question. Have you ever felt embarrassed, anxious, or even ashamed because of your credit score? Maybe you checked it online and you thought, wow, I really need to fix this. Or maybe you've bragged about having this phenomenal high credit score, thinking it meant you were doing so well financially. Here's the truth. The credit score is not a wealth score. It's not a success score. It's not even really a measure of your financial health. It's just a financial risk score. It's a way for lenders to decide if they can lend money to you, semi-risk free and make money off of you in the long term. But here's the problem. When we obsess over it, we miss the big picture. We chase this number instead of chasing true financial freedom. And today I want to flip that script for you. The credit score is showing up everywhere. If you're using a common budgeting app today, whether Quick and Simplify, I think YNAB can pull these in. If you have a credit card at all, it probably is pulling in through like a CreditWise or something like that. You are getting access to your credit score easier than ever before. And what that tells people is it gives them a constant reflection of this score that many believe is a financial score or a financial success score. And it sends them down this path of trying to achieve this idea that if I improve my credit score, that means that I am doing better financially. So let's start there. Let's clear up the basics. What is a credit score? So I want you to think about a credit score in terms of a report card that you get in school. It doesn't measure how smart you are in every area of life, and it just measures how you performed in a very specific subject at a very specific time. Because you scored a D in your 11th grade mathematics class does not mean that you are bad at math, right? It is a very specific subject at a very specific time. You are much smarter today, I'm assuming, than you were in the 11th grade. Plus, in the 11th grade, you were probably halfway paying attention, and nowadays you probably pay more attention, right? So your credit score is this score that's meant to be a very specific subject, but very specific time and place, and it's usually between 300 to 850. It's basically your financial report card for borrowing. And get that word, it's for borrowing. Lenders look at it to predict, if I give this person money, what is the likelihood that they will pay me back on time? Or am I going to take on more risk than it's worth for me to lend out this money? Now, how is it calculated? Well, common areas that people look at is payment history. So are you paying your bills on time? Your debt owed. So how much money are you already owing to other lenders? So how much you already carrying in debt? Credit history. How long have you been borrowing for, right? Types of credit. Do you only have credit cards or also loans and mortgages, so forth and so on? And what are those new credit inquiries? Like, have you been shopping around for more debt? Now, I want you to think about that in logical terms. Payment history. Are you paying your bills on time? Well, first and foremost is if you have $100 and you have a bill for 50 and you also want to go out to eat and it costs 60, are you going to forego that $60 meal to pay your bills, right? Like very good measure of if you're making the right priorities in life in terms of putting your financial obligations first before your financial luxuries or your personal luxuries. Debt owed. How much are you already carrying, right? Because people don't tend to get into debt and say, oh, let me get some more debt. Like most people don't think like that. They end up having to rely on more debt and they can bury themselves in a hole of debt. So very good measure of how well are you doing, right? Like, are you risky? If I'm the first debt that you got, I might be more likely to get paid back. If I'm the fourth debt that you've now gotten and you're adding and adding and adding and adding, I'm starting to develop a trend here. You're going to open an account, you're going to max it out, you're going to move to the next, right? Like, so a lender will look at that and say, well, this person's a little more risky now. Let me be careful. Credit history, how long have you been borrowing? So the longer you've been borrowing, the more history they have to look back at. Types of credit. If you're constantly in those in the credit card space, credit cards are easy to open. You open it, and in some cases nowadays, you can use it like within hours of opening the line of credit. Loans and mortgages, some of those have assets behind them that you could they could help with some type of kickback for the loan if it did default. But different types of credit lines show like various levels of financial maturity. And new credit inquiries, yeah, like if you're shopping around for more debt, you're possibly constantly in the need. So going through all those, what's missing? What's missing? Well, things like your income, not in your credit score. Things like how much you have saved, not in your credit score. Things like your investments. How much are you investing into your long-term wealth building, vehicles like IRA accounts and brokerage accounts, things like that, 401ks. Your net worth is missing in that. Man, is it missing? All of those are much better reflections of your financial success. None of that's factored into a credit score. Not a single one of those things is factored into credit score. So you could be a millionaire with no debt and still have a low credit score. Or you could be broke and drowning in debt, but have this great, phenomenal 830 credit score because you keep making your minimum payments. So to a lender, you're making them money. They appreciate you. They love having you as a customer. It's kind of like judging someone's health only by their weight, right? Like it doesn't tell the whole story. It's the reason why BMI gets a bad name, right? Like it is the reason why BMI gets a bad name because it does not tell the entire story. Is it good reflection of where you're at? Maybe, but it doesn't tell the entire story. So here's something that most people don't know. There's this other score out there that's called an insurance score. And insurance companies look at this similar to how your credit score is used with financial institutions. It decides how risky you are to insure. It's not about whether you're wealthy or not. It's about how likely you are to file a claim. And in fact, data shows that in Michigan, for example, drivers with excellent credit pay about 59% less for auto insurance than those with poor credit. For homeowners, the difference is around 77%, and that's huge. But here's the kicker. You don't even get to see your insurance score. It's behind the scenes. It's just a tool they use to set prices. If you're more likely to file a claim, you're more likely to cost them money. You're a riskier customer to them, right? Well, so why do I bring this up? Why am I creating this parallel between insurance scores and credit scores? Well, it's to show you that credit scores and insurance scores are not wealth indicators. They are simply just risk ratings that companies use to make money. That's really all they are. And when we obsess over them, we are playing their game instead of focusing on building our financial security, right? That's really what it's about. If you get so fixated on having a perfect credit score, all of a sudden you end up playing their game. You end up making them money, hand over fist, make them money, because the more you take on debt, the more you pay in interest, the more money that they make. They want you to open lines of credit when you have great credit scores. They want you to try to drive your credit score up to the ceiling because of the simple fact that you are making them money. So I'm going to give you 2 real world examples of clients that I've worked with. And one had a really good credit score. One had a credit score over 750. And on paper, she looked amazing, right? But the truth is, she was drowning in debt. She was living paycheck to paycheck, barely scraping by, making minimum payments, but her score looked great, but her financial life was falling apart, right? Great credit score, terrible financial life. On the flip side, another client, 0 debt and fully funded emergency fund, saving aggressively for retirement, in a fantastic financial position. But because he had not used debt in years, his credit score was low. So on paper, he looks risky. He looks like a risky financial borrower, right? So ask yourself, which one of those people is actually in a better financial position? Well, the one with the great score, but piles on debt, is not in a better position, right? They are living paycheck to paycheck. They are barely scraping by. They are not setting aside money for savings. They're not building wealth. The person with 0 debt and doing all those other right financial things, like focusing on investments, focusing on building wealth, focusing on savings rates, focusing on their improving their income, all of those things, that's the person that is financially successful. That is the person that's doing the right things on the right track to get to where they need to be. So this is why, and this is a clear example of why obsessing over your credit score is dangerous. It gives you this false sense of security, and it can even trap you in debt. And I've seen people time and time again that have become almost obsessive over a credit score, almost obsessive over their credit score and what it means and how do I get it higher and how do I improve my credit score. And what I would tell you is that a lot of times what they're trying to improve their credit score for is to buy a home. Almost every time when I talk to people, the reason that they're so fixated on improving a credit score is because they've spent years and they've really destroyed their credit, and they think that that's the only way to get a home, right? And so they start to take on new debt to try to improve a credit score that they could end up going the opposite direction and make it worse, make all things worse, right? It's like fighting fire with fire. Like it's dangerous. It's super dangerous. So first off, but to answer that question is you don't need a credit score to buy a home. There's ways around that. Much harder ways to get a home. But I'm here to tell you that you can build your credit without taking on additional debt, right? A credit score is not a measure of true financial health, right? It's not. But there are things that you can do to start improving your credit naturally. So a couple of things that I first want to wrap your head around is like, what actually defines financial stability? And then I'm going to move right into how just doing these things, focusing on these financial stability items, there's a couple of little pieces in there that we can start to lean into to naturally improve our credit score. So what really builds financial stability? Well, the first thing that I would tell you, and this is a short list, 4 quick items, but the first thing that I would tell you to really focus on to build financial stability is have a get out of debt plan and start following it. If you're in debt right now and you don't have a plan to know exactly what day you're going to be out of debt, you're not attacking your debt in the right way. You've got to have a get out of debt plan. You've got to have a plan in place that says, here's how much I'm going to pay this month to this account, and this month to this account, and this much to this account, and this is when I'm going to be out of debt. You've got to have that to a T. You should know when you're going to be out of debt. If you don't know that, and it's all just like, well, I'm just going to do this and this, you don't have a plan. You don't have a plan. You're going blind. So get out of that plan and start following it. That's number one. Number two is create a budget and start sticking to it. Everybody I've ever talked to that has not budgeted, that has started to budget, has felt like they've earned their life back, their financial life back, and they've really got on track financially. Create a budget and stick to it. I promise you it'll change your life. Third thing is build you an emergency fund so you don't have to rely on credit cards. $1,000 up front until you get out of debt, and then start building that 3 to 6 months of expenses into that emergency fund. Crucial. You can't rely on debt to get you out of tight pickles, right? So get your emergency fund together, and all of a sudden life will get easier. And the last thing that I would tell you to really start on to build your financial stability is grow your net worth. Net worth is assets minus liabilities, or assets minus your debts. Those are the things that if you will focus on, you will start to improve your financial stability, right? Think of it like building a house. The credit score is like paint color on the walls, but the nice things to have, but not structural, is all credit score is. Foundation is your budget, your debt payoff, your savings rates. Without those foundations, your house is going to fall apart. It doesn't matter what color you painted your walls. It doesn't matter if you have granite countertops or not. All that's a credit score. All that's fluffy stuff. It doesn't matter. True things that matter: your budget, your debt payoff, your savings rates, your income, your net worth, things like that matter. Okay. So how can you improve your credit score naturally? How can you not take on new debt to improve your credit score? Well, I'm not saying that you should ignore your score completely, first and foremost, because yes, there are times when it matters. Like when you're applying for a mortgage, I'm here to tell you that you don't have to have a credit score to do that, though. Please keep that in mind. But the good news is that if you practice healthy financial habits, your score will improve naturally. First thing you can do is pay your bills on time. That's the biggest factor. Pay all of your bills on time. More and more companies nowadays are reporting on-time bill payment to credit bureaus. More companies are. I'm still not saying there's a lot, but there used to be none, right? So focus on that. It's a big factor. Pay your bills on time. Pay your bills on time. Pay your bills on time. The other thing you can do is if you are using credit in some capacity, some type of debt, like a credit card, keep your balances low. Ideally under 30% of your credit limit. Ideally under 30% of your credit limit. That does help. It does help if you are using credit cards. My suggestion on credit cards is to first build really good financial practices before you introduce credit cards for rewards and all that into your life. I've talked about this at length, but I do not believe in people using credit cards for rewards if you're in debt. Get out of debt first. Get out of debt first, build good financial habits, build good financial practices, then reintroduce credit cards after you've done that, right? You need to have a solid foundation. You need to be structurally sound before you introduce credit cards into your life. The rewards are not that great, first and foremost. And if you're going into debt to get stuff, I'm telling you, it doesn't pay for itself. I promise you. I did an episode on that it's probably been beginning of this year, I believe, when I talked about travel rewards and how going into debt's not worth it. But that's one thing. Don't open a bunch of new accounts for credit scores to improve. Pay your bills on time. Pay your bills on time. Pay your bills on time. And I know today, like I said, routine bills like utilities and phone bills may report to credit agencies, so that does help your score. But that's the thing that I would tell you, is that these are just some of the habits that help improve your financial health. These are not just habits that are going to improve your score. If you will do these things, you will all of a sudden realize that your score doesn't matter. It doesn't matter at all. Build these habits, the score will follow. Build these habits, the score will follow. And I'm telling you, if you walk into a home mortgage and your credit's kind of messed up, but you're like, yeah, I'm dropping 30% down right now, that bank's going to be like, whoa, okay. Putting your money where your mouth is. I got it, right? Like the whole situation changes. Yes, you walk in and say, yeah, I've got a 3% down and I've got a 450 credit score. Bank's going to tell you to kick rocks, right? Bank's going to tell you to kick rocks. But walk in with a 30% down payment. Walk in, start saving some money. I guarantee you some cash, hard, cold cash is not going to have that bank telling you to go kick rocks and get back in your car. They're going to at least think about it. And you shop around and find the right bank, they'll probably take you regardless of what your credit score is, right? I'm not a banker. I'm not here to tell you that they're going to take you or not, but I'm telling you that you are a different risk profile when you walk in with 30% down. You're a different risk profile, and they may take into consideration, right? So here's the mindset shift that I want you to take away from this today. Your credit score is not your financial identity. It's not a badge of honor. It's not proof that you're financially successful. It's simply a number that lenders use to make money off of you, right? Real wealth is freedom from debt, freedom from worry, freedom to build the life you want, right? So stop stressing whether your score is a 680, a 720, a 820, whatever. Start focusing on building stability, build your emergency fund, stick to your budget, pay off debt, and grow your net worth. That's what really matters. So my challenge to you is the next time you're tempted to check that credit score, ask yourself, what did I do today to build my net worth? Did I stick to my budget? Did I pay down my debt? Did I do something to save for my future, right? That's where the power is, and that's where the freedom is. I hope this episode landed with you. I'm hoping this episode gave you something to take away from. Share this with a friend, a coworker, whomever that you think needs just a little bit of help in this space. But I appreciate you tuning in. And until next week, continue improving the one thing you can control, yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, help us grow as a community. Please like, subscribe, and share with the people in your lives.